We are kicking off the week with some futures optimism here. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, President Trump calls on other nations, including China, to help secure passage through the Strait of Hormuz.
Oil market set for more turmoil. Brent trades above $100 a barrel at the start of the week, though futures start to drop.
Plus, Meta rallies on a report of sweeping layoffs while Nvidia kicks off its AI conference with investors looking for a surprise to jolt the stock.
I feel like that's the lesson all these companies are going to learn. Lay off people, say it's because of its AI, and the shares will rebound and bounce.
Right, but can you have sustainably strong earnings with fewer people in your workforce?
Well, I guess Meta's about to find that out. Let me show you what the stock is doing this morning. It is up 3%, and this is kind of two sides of the trade. So Meta says it's going to cut 20% of its workforce to offset AI costs. That was a Reuters report. And then they also announced plans to spend up to $27 billion over the next 5 years to access Nebius cloud infrastructure. It's a neo cloud, whatever that is. So firing employees so can invest in Nebius, basically.
All right. That's a big bummer, obviously, for a lot of people feeding families. Let's take a look at what's going on in the markets right now. S&P futures are higher, 0.9%. We closed down on Friday. You do have Brent crude giving up some of its gains right now. It's down to 101.67. It had been up to 105 and hanging out in that area for a while. NYMEX WTI was up over $100 for a while last night as well. The 10-year yield coming down about 5 basis points now to 4.23. So it looks like risk-on moves are in store for this market this morning, Dani.
And we're tracking the geopolitics as to what we'll do to oil and other assets. President Trump trying to assemble allies to reopen the Strait of Hormuz as the war with Iran shows no signs of letting up. Trump also claims that the Iranian regime wants to make a deal, but Iran's foreign minister says that is not the case.
No, we never asked for a ceasefire, and we have never asked even for negotiation. We are ready to defend ourselves as long as it takes. And this is what we have done so far, and we continue to do that until President Trump comes to the point that this is an illegal war with no victory.
Let's get the latest with Bloomberg Washington correspondent Tyler Kendall at the White House. So, Tyler, certainly some conflicting messages between Iranian leadership and this White House.
Right, Dani, good morning. Conflicting messages after President Trump appeared to float the possibility that we could see talks, but then that was shot down by Iran, saying that that outreach hasn't happened. We heard from President Trump over the weekend saying that it is because of him that an agreement hasn't been reached, because he is unhappy with the terms that have been put forward, saying that in order for him to agree to a deal, he would have to have firm commitments that Iran was abandoning its nuclear ambitions. At this point, it is unclear exactly who is speaking with whom and if those talks are actually happening, as the White House does intensify its calls to reopen the Strait of Hormuz. Of course, the top disruption that we've been watching closely. And as you mentioned at the top there, President Trump is now demanding that allies take part in potential naval escorts to secure the strait, though at the moment it appears that our allies are wary of that movement. A NATO official did confirm in a statement with Bloomberg News earlier today that individual allies are in talks with the U.S. about what more could be done in regards to the strait, but it appears that efforts are falling short of a full naval mission. For example, we heard from the UK Prime Minister Keir Starmer earlier this morning, who said that a NATO mission will not be sent to secure the strait, though people familiar with the matter do tell us here at Bloomberg News the UK is floating some other potential options that could be put on the table, including potentially deploying autonomous mine hunting drones. Matt and Dani, this comes after over the weekend President Trump did threaten the NATO alliance in an interview with the FT, saying that NATO will have a, quote, very bad future if it doesn't deploy ships. We know that this is something that is actively under consideration and a top priority for this White House.
I know, Tyler, that French President Emmanuel Macron said it's up to President Trump to clarify his objectives. He reportedly declined to clarify those objectives in a call with our allies, and he told a Fox news host that he'll know the war is over when he feels it in his bones. But he did tweet on, or post to Truth Social on March 6th, that there will be no deal with Iran except an unconditional surrender. So that means there would be no terms at all. They have to simply say, we quit and we're at your mercy. Are these objectives, are these goalposts going to stay where they are?
Well, Matt, we're going to ultimately have to wait and see, because as you're laying out here, there has been mixed messaging from the administration, though if you ask officials here at the White House, they still maintain that those core goals when it comes to dismantling Iran's nuclear program, its ballistic missile system, and its support for proxy militia groups remain front and center. But you're exactly right. There are, of course, questions here about exactly how the administration is going to be measuring progress. As we heard from some senior administration officials in interviews over the weekend, that they do expect this war to continue on for the next few weeks. That, of course, then raises questions about just how long we could see these disruptions. For example, last, when it comes to the Strait of Hormuz, I will put on your radar that President Trump had appeared to threaten that he could delay his trip to China, for example, if we don't see Chinese involvement in sending ships over to reopen the strait. Though we did hear from the U.S. Treasury Secretary Scott Bessent in an interview earlier this morning, appearing to downplay that there would be a connection between China sending ships and President Trump delaying his meeting. But that's another thing to keep on your radar, as it appears it could be possible that President Trump would delay that critical visit to Beijing at the start of next month.
All right, Tyler, thanks very much. Tyler Kendall there at the White House. Oil, right now we see giving up some of the gains that we had seen earlier. Here's Brent crude now coming back down to $102 a barrel, and we see NYMEX WTI. It had gone up over 100, is back down now. This, even as Iran steps up attacks on ports and airports. B of A commodities analyst Francisco Blanche says the next 2 weeks are crucial for reopening the Strait of Hormuz.
Shippers themselves will be very, very cautious not to take that route if there's risk of their vessels ending up in fire. And we've seen 20 of those already being attacked or so, I think. So it's a difficult time for shippers, for insurers. Everyone's kind of waiting for a resolution, but if it doesn't come up in the next few weeks, I mean, I'm going to give it maybe until the end of the month, things can get very, very complicated for oil prices.
Let's discuss with Will Kennedy, Bloomberg News director for Europe, the Middle East, and Africa. And Will, it seems as though it would be in the best interest of Iran and obviously in the best interest of Russia as well to keep the Strait of Hormuz closed.
Good morning, Matt. That's going to be the concern right now, is that for Iran, this is the point of maximum leverage, and the longer it can keep the strait closed, the more economic pain it will inflict on the rest of the world, putting pressure on the US to find an end or an exit from this war. But prices are down today, and I think that reflects some hope that there may be a solution at hand. But the other thing it reflects is that we've got to look at the energy system as a whole, and that crude oil is only one part of that. And if you want to look at the pain, you should be looking at the refining system, some of the products that come out of refineries like jet fuel, fuel oil that's used to power ships, and diesel that's used to power cars and trucks and factories around the world. And those prices are very high indeed. And so there's not oil able to go into those refineries, but that's sending the price of refined product much higher.
Well, one of the bets that this president seems to be making is that the pain will especially be acute for China, that China needs the Strait of Hormuz to be open, and President Trump floating this idea that the summit with President Xi would be delayed unless China does help. Does it seem like there is any willingness from China to send escorts, to send a navy to help open the Strait of Hormuz, and is it necessary for them to do so?
I think most people think that that's quite unlikely. For the Chinese to use its naval power in that way would be unprecedented. And it's also incredibly striking that the US president, who's often leads a country that's often had an antagonistic relationship with China in the last few years, and that sees the rise of China as the greatest strategic challenge, is asking for Chinese military help to solve this problem. Yes, in some senses, interests are aligned. The Chinese need this strait to open at some point soon. It has insulated itself with some very large strategic reserves, but it gets a lot of its oil supplies from the Middle East. So the interests are aligned. But whether China would be able to lend that very direct military help to solve this problem seems quite unlikely.
Will, thank you very much for that. That's Bloomberg's Will Kennedy in London. Now, elsewhere, away from the war in corporate news, Meta is reportedly planning layoffs that could affect 20% or more of the company. It's also spending $27 billion over 5 years with Nebius to build out AI infrastructure. Let's get to Bloomberg Tech's Ed Ludlow. Ed, just how necessary are layoffs at Meta in order for them to keep spending at the rate that they are?
Yeah, I mean, the capital expenditures commitment is very high, and the Reuters report details that is the trade-off to make cuts at 20% or beyond 20% of total workforce because of the rising infrastructure spend. And the interpretation of the sell side on this is interesting. They look at the Block announcement for a few weeks ago and say that, there is evidence within Meta internally that AI productivity could help them, and that would be a part of the story in eliminating some roles. But also, it's a signal of intent to keep spending. And if you're going to do that, reducing headcount at those levels also protects margins, right? The terminal team with that chart just showing capital expenditures as a proportion of revenue, very, very high. But Meta's still a profitable company, right? And so protecting the bottom line is something that the sell side has kind of cheered, and one reason the stock's up in the pre-market such as it is.
What do we know about the deal with Nebius, Ed? Last week we were talking about Meta's own chips, and maybe they're not quite there yet in terms of competition with Nvidia or Google. But will they be using their chips in these neo clouds?
Yeah, it's the everything strategy. So their own chips, buy Nvidia and AMD chips for their own data centers. And then this third part of the strategy is the neo cloud, buy AI-specific capacity. So it's a 5-year agreement for $27 billion total, but $12 billion of committed or dedicated compute next year. That's quite aggressive and accelerated timeline. Nebius principally relies on Nvidia-based systems, and that's been a part of their selling point, just as CoreWeave in this country has made it a selling point as well. And they need compute. They are compute constrained. The demand for internal workloads is greater than they have access to. So this is a big spend by them on the neo cloud portion.
Yeah, the risk is in execute and supply. Not in demand, as Mark Zuckerberg has made very clear. Ed Ludlow, Bloomberg Tech co-anchor. That show kicks off at 11 a.m. Definitely tune in for more on that. Let's get a look right now at some of the other movers on our radar this morning. Alibaba is revamping its business to put all AI products under a single unit that will focus on profitability. So you see Alibaba shares. These are the ADRs here trading up 3%.
In other tech movers, Micron sealing a deal to build another site in Taiwan. That was announced 2 months ago. They also report earnings on Wednesday's shares climbing more than 4% ahead of that.
And Dollar Tree delivered a mixed annual outlook, raising doubts about its ability to keep winning over shoppers with low prices.
And finally, some deal news. Public Storage set to acquire National Storage in an all-stock deal worth about $10.5 billion, creating a $57 billion storage giant.
That's a legit Halo asset, right?
Yeah, that's Bruce Richards likes Halo, right?
Yeah, I mean, a lot of people like Halo right now. Hard assets, low obsolescence, I believe, is the O.
Yeah, that sounds right. Yeah. Well remembered.
All right, coming up, UniCredit's attempt to take over Commerzbank, or is it? Berlin says no. We'll talk about it with Steve Aarons out of Frankfurt next. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. The Wall Street Journal is reporting that Apollo executive John Zito has warned of arrogance in private markets, saying troubled private credit loans to smaller software firms may recover only 20 to 40 cents on the dollar. He says many private equity valuations are wrong. He's actually said literally all marks are wrong, but a spokesman later clarified that he was referring only to the software loans out of private credit. So we'll continue to keep an eye on this space. Obviously, this show is very focused on the private credit party, as Mr. Zito called it in what was apparently an off-the-record conversation. Elon Musk's AI startup, xAI, is recruiting Wall Street bankers, traders, and credit analysts to train its Grok chatbot on complex finance strategy. The hires will help Grok to model deals like leveraged loans and mortgage bonds as AI firms race to sell tools to investment professionals. The push comes as xAI tries to catch up to rivals like OpenAI and Anthropic in business software. And UniCredit is making a $40 billion bid for Commerzbank, pushing its stake past the key 30% takeover threshold under German law. The CEO of UniCredit, Andrea Orcel, says the move gives his bank flexibility over the potential of a future takeover, though full control isn't the goal right now. A formal offer is expected in early May. And joining us now is Bloomberg's Stephen Ahrens. He leads our EU finance coverage out of Frankfurt. And Stephen, they have to make this offer, right? It's a procedural motion after they pass the 30% stake. But they don't seem to want to take over all of Commerzbank right now. So why build such a big stake?
Yes, you're right. The offer sort of needs to take place and then gives Commerzbank the freedom. It's going to be off the table. They don't expect many people, any people really, to accept it. And then they're free to buy more shares if they want to. So that's the, I think, the rationale behind this. They want to be able to actually take over the bank, but they can't yet. There's government opposition to the potential deal. And once they have that flexibility, they have more time to talk to the government, to talk to the bank, and prepare, lay the groundwork for a potential acquisition bid further down the road.
Well, they'll need that time to talk with the government because already the German government, Stephen, has dismissed this, calling it unacceptable. What is their position?
You're right. The government is very clear. They've been against this deal from the very start when Orcel first disclosed the stake in UniCredit a year and a half ago. They've always said, we don't want this to happen, and they've reiterated that position just today. So it's very unlikely they ever change a position, but it seems Orcel is just not giving up. He really wants this deal. He really wants Commerzbank. He realized it's going to be really difficult to buy Commerzbank if Berlin continues to oppose it, but he's just banking on time. I mean, the government could change, I suppose, or even the stance, and that's what he's preparing for.
It seems like, everybody's pushing for cross-border mergers as a goal. The ECB has stated this, and most governments are for it as well. But no one wants one of their own banks to be the target. Is that how it sits in Europe right now, Stephen?
Yeah, I mean, it's absolutely true. Everyone is paying lip service to the idea of an integrated Europe. But when it actually affects their own banks or their own financial services companies in their own country, there's a lot of reticence. They don't want it to happen. They want to have control, domestic, national control over those very crucial parts of domestic infrastructure, and they hate the idea of giving it up. So yes, that sort of nationalistic feeling plays a big role here, despite all the claims that they support European integration.
Stephen, thank you so much for joining us this morning. That's Bloomberg's Stephen Ahrens. And catch Bloomberg Deals. That airs every Wednesday at 12 p.m. New York time, hosted by yours truly. This will definitely be part of the conversation this coming Wednesday. Coming up on this show, mixed messages from Wall Street strategists about a stock market reaction. We asked RBC's Lori Calvasina where she stands. That's coming up next. You're watching Bloomberg Open Interest. Strategists still see equity pain ahead, but no bear market. Goldman's Peter Oppenheimer warns of a downturn, but says we are not going to get that 20% decline. He says that geopolitical and energy shocks have historically led to short-lived corrections and reverse quickly. Meanwhile, Morgan Stanley's Mike Wilson believes the correction phase of this conflict is nearing an end. The S&P 500 is down 4%. I don't know if you can call that a correction from its highs, and had its worst two-week performance since April's tariff turmoil. Joining us now is RBC head of U.S. equity strategy, Lori Calvasina. Lori, is it your expectation that there's more pain in store for this equity market?
So it wouldn't surprise me. I mean, we define on our tiers of fear, and I know I'm scaring everybody by talking about this. I'm actually not that bearish.
Not at all, actually.
I'm not.
I don't think you're bearish at all. Yeah.
No, I'm actually pretty neutral. But, part of it, right, last year around tariffs, actually heading into that situation, we kind of formalized our process for thinking about drawdowns. And so we sorted them into 4 tiers, which we call the tiers of fear. And tier 1 is a garden variety 5 to 10% drawdown. We tend to have these often, right? We had one last October and November that bottomed out at 5.1%. It's possible this could be it, right? I mean, that one that we had last fall felt like it would go much deeper, and it didn't. And the U.S. is benefiting right now from, kind of the safe haven trade at the moment. So, it's certainly possible this could be it, but it wouldn't surprise me at all to see us go down a bit deeper. And if you kind of hit that 10% mark, 6,300 is about where you go. Now, we have said that the second tier of fear, which is what we had last year, that 18.9% drawdown, we've had 5 of those since the great financial crisis, where we've had peak to trough declines of 14 to 20%. Risks of that have grown, but you have to get to a point, right, where there's genuine fear of either a recession or some sort of contagion. And I don't think that's where we are yet. I don't think we're really even close to that, frankly, from talking to clients, from seeing what companies have been saying. I was at our financials conference last week, and the tone was solid and steady. So I understand the fears and kind of looking at that left tail worst case scenario, but we're just not at that point yet where you'd even kind of get to a tier 2.
Did you see the John Zito story in the Wall Street Journal today?
On private credit.
Top dog at Apollo. Yeah, not just private credit, though.
Yeah.
He said, I told my wife last night, I feel like the market should be down at least 10%.
Yeah.
And that was last month. That was before we invaded Iran.
Yeah, well, look, I mean, I don't want to sort of speculate. I wasn't in the room, right? But in terms of why we've been so resilient in the U.S. equity market, we've been watching PE multiples creep down since last August, right? And it's been AI jitters. It's been private credit fears. Geopolitical tensions, frankly, started to really balloon back in January. I was up in Canada the first week of the year. We talked mostly about Greenland, not really about Iran, but I went back and looked at betting market data, and we actually saw expectations for the U.S. to strike Iran spike back then, and that's around when the S&P turned choppy and the energy trade really took off relative to the S&P. So I do think there was a tremendous amount of preparation going into those strikes. I think obviously people were not anticipating the extent of it. And when I talk to my colleagues sort of on the derivative side of the business, right, it seems like a lot of people have been very well hedged coming into this. So I think there is a lot of nervousness, but I think there's also a lot of protection on as well.
All right, you're going to stay with us, Lori. We've got the opening bells up next as futures rise this morning. Oil back down to only a mere $101.78 a barrel for Brent crude. S&P futures higher and NASDAQ futures up by more than 1%. We're back with the opening bell on the other side of this break. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller, looking at pretty decent gains in terms of futures. 0.9% on S&P futures. NASDAQ futures up more than 1%. It may be that this market came down. At one point, it was down 5%, at least intraday, and that's enough of a correction, I guess, so that we're off to the races again. Ireland Inc. ringing the opening bell at the New York Stock Exchange. We're going to talk to Peter Burke later on in this program. I think they're ringing the bell today because tomorrow, St. Patrick's Day, is a market holiday, so they wouldn't be able to.
It's
not a market holiday.
No, it's not. I was like, I'm unaware of that.
It should be, I think.
If anything, the day after should be.
Why not? Exactly, Wednesday should be. Acadia ringing the opening bell down the NASDAQ, ACAD. The stock is down by more than a fifth year to date, so hopefully this gives them a little bit of a boost in terms of performance.
Speaking of boost, I'm looking at Meta and Nebius this morning. Reuters reporting that Meta could cut up to 20% of its workforce to offset AI costs. People kind of pointing to the block firing of people too and saying, hey, this is a very similar thing. You free up capital in order to spend on AI, or at least that's what you say. But Meta's not just saying it, they're doing it. Planning to spend up to $27 billion over 5 years for access to Nebius's cloud infrastructure. Nebius now up 13% at the open, Matt.
All right, we're also watching Dollar Tree. It anticipates slowing sales growth this year, raising doubts about winning over shoppers with its low prices. Shares were negative after the report, but are climbing right now, up more than 4%. Let's bring back in RBC head of U.S. equity strategy, Lori Calvasina. And Calvasina, is that Irish? Are you Irish?
It's Italian. It's Italian.
It's your birthday, though, today. Happy birthday.
Happy birthday, Lori.
Lori. You see Dollar Tree's glum outlook, and I wonder if you're not worried about the consumer as gas prices start to rise again. What are we at, $3.70 now for regular unleaded, and the consumer is squeezed in so many other ways. Inflation, PCE, core PCE was 3.1% in the last reading before the gas prices came into play. How could you be so bullish on the stock market as we get into this forever war?
Well, it's funny. I was at a dinner last week with my rate strategist, Blake Gwynn, and we were actually debating this point, and I had to remind him the U.S. equity market, the S&P 500 specifically, it doesn't have the same weight to the consumer that the U.S. economy does, right? And, just to give you sort of an illustration of that, a couple of days after the Iran situation broke out, I went to my U.S. analysts and said, look, I said, I need you to fill out this survey. I'm really sorry. And they were actually great. And I had a few people who even thanked me for doing it. But we just said we want to gauge impact from this conflict if oil goes above $100 for an extended period of time, and if the conflict goes on for an extended period of time, which we define as more than 4 weeks. So those were their parameters, and we said, we want you to gauge impact to earnings from oil and gas. We want you to gauge revenue exposure directly from the Middle East. And third, and I think most importantly, we want you to gauge the impact of knock-on effects. And so then they had 5 choices. They could say none. They could say only a little. They could say mixed, not relevant. They could say some, a decent amount, and then they could say a lot. And so those latter 2 were sort of in the more significant impact category, and the first 3 were kind of the lesser significance category. On the earnings question, 72% fell into those 3 categories of lesser significance. On the revenue exposure question, it was 77% that fell into the lesser significant categories. Now, knock-on effects, there was more impact seen, but it was still surprising that 66% fell into those less impact categories. Now, 2 of the sectors that were viewed as being significantly impacted were consumer staples and consumer discretionary. The other one was materials. So we took away from that yes, there are pockets of risk. You want to be concerned about those, obviously. And talking to Nick Modi, my consumer staples analyst, I actually went back to him with a survey, and I said, because he scored, as more significant across all 3 of the questions. And I said, I want to make sure these are your real answers, because people are going to think staples is defensive, but you're telling me it's not by answering this. And he said, no, I agree with that. So, we do think...
You agree with that it's not defensive?
That staples may not be as defensive as you think it is in this conflict.
Why is it different this time? You have seen that in the market price action. It was down nearly 5% in the first week and down 1.2% last week.
Yeah, so look, this was a sector, we've been neutral on this sector, right? But we've classified it as one of the ones with better valuations, and that was a good data point coming into the year because people really did want cheap sectors, right? You actually saw the sector benefiting from that early on in the quarter. But as things wore on, I know there was one day, I forget if it was last week or the first week, but consumer staples were just getting whacked across the board. And I talked to my trader, and there were not really, there was one company that had a bad earnings data point, but then others were just sort of getting pressured. And I was also seeing materials was the second worst performing sector, along with staples out of the gate.
That's a halo trade, materials. I thought that was hard asset, low obsolescence.
Well, look,
commodities are just through the roof, right?
Well, I will say materials, the metals and mining trade, was really what was gassing a lot of that, and that's actually started to look a little bit expensive in here. But we do think that what we learned from that analyst survey, right, is there are pockets of risk, but this idea that the broader U.S. equity market has some insulation, you're hearing that from a bottom-up perspective. And I learned a long time ago, had a lovely transportation analyst I used to work with back in my Credit Suisse days. And, we would go, all the macro people would talk about all these things going on. And I just remember I would always talk to Allison, and her name was Allison Landry, and she covered the rails and other transportation and logistic companies. She'd say, well, my companies aren't saying that. And, she would be very direct with us, yeah, you guys can go off and, sort of think whatever you think. But, until the companies actually start giving us color on that, investors are not going to pay attention.
Lori, one of the things I've been kind of obsessed with over the past week, that this came from a cocktail party conversation, but this idea that so much
cocktail party is a really nice way to put it.
Thank you, Matt. That's exactly what it was. But this idea that so much of what we're seeing in equity markets can really be attributed to the pod shops, that all of the money gets concentrated in the winning pods, so momentum goes up really hard, but they have really severe risk parameters. So when the market turns against them, they degross and get as low to the ground as they can. So over the past 2 weeks, what we've just seen is is unwinding of software shorts, so software does better, selling everything else off, and that's why a lot of the market moved lower that maybe didn't seem like it made sense. How much of this market has just been positioning and from these pod shop hedge funds?
You know, I don't have a specific number on that. I think that's generally the right instinct. I do think that what my long-only managers tend to do when you're in markets like these is sort of sit back and wait and see what happens and then look for things to buy on dislocations, right? And, you know, I think software, I had some conversation, you know, this is pre-Iran, but I had some conversations about software when we were going through that AI, you know, jitter trade that turned into a scary trade really fast. And I remember talking to some people and they're like, well, you know, yes, the valuations are cheap, but people are looking at cash flow. We have to sort of sort through that. I remember someone telling me, you know, I want to see, you know, sort of more capitulation from the sell side. I want to see more analyst downgrades. And I don't know if this gentleman has, you know, kind of moved in yet or not. It's been a little while since I talked to him. But the reality is I do think that long-only managers do tend to look at things with a longer-term lens and will sort of look at that noise created by the hedge funds and figure out where they can be opportunistic. And I heard a lot of that around the tariff example, for example.
I'll bring John Zito up again, because in this off-the-record discussion he had at UBS, or with UBS clients, the Wall Street Journal reports, he said, I think it's more likely than not we go into a recession, a consumer confidence-led recession.
Well, let me tell you on consumer confidence. Okay, so if we look at both the Conference Board data and the Michigan data updated on Friday, and I tend to watch that because post-COVID, it's had a pretty decent relationship with the stock market. It's broken down a little bit the last year, and it's been a good barometer for sector performance since the financial crisis. So I do watch the Michigan data pretty closely, and even with the downtick it saw last week. So if you look at that press release, they said basically, you know, things were pretty good in the first half of the survey period before Iran, and then things came down and offset the gains in the second half, right? And people were mentioning gas prices. That at least is my take on the press release. And so we know that this conflict had an impact on that and ended up knocking the data point down. But even with that knockdown, we've seen that time series sort of stabilizing around, you know, pretty extreme lows in recent months. So you just have to remember that coming into this, the consumer was already, you know, not feeling great, frankly. When I asked my analysts about knock-on effects, consumer confidence and inflation were the top two. But guess what? We have been dealing with those consistently in the post-COVID environment. So the question, right, is are companies able to work around those kinds of issues? And I think the jury is still out on that. But I have to tell you, this private credit conversation needs to evolve. We are hearing a lot of companies, I'm not speaking about any particular company. We did have a BDC panel at our conference last week and a number of other speakers. So we wrote about this a little bit in our weekly today. But if you sort of think about the conversation, right, it's like, well, I'm better off than this firm. And if there's a recession, yeah, the metrics are going to get messier. I think that the bigger issue, right, is that there is just not a lot of transparency in this industry, right? So when folks like me try to sit down and analyze risks, it's very, very difficult to do so. And we're kind of stuck in this narrative. And I think what we need at this point is more focus on the industry and more evaluation of the industry. And we need to have players stop pointing fingers at each other, frankly. We need to sort of really understand what are the risks of this industry to the broader financial sector. If you talk to Gerard Cassidy, he would tell you, you know, he's not overly worried, would be my guess. We had some companies at our conference specifically say they don't see a massive correction. They don't see contagion. Like, they are watching this issue, right? But I think that we're just sort of stuck on the narrative right now. Yeah. And I don't know who is going to break us out, but somebody needs to do it.
It's such a good point. It is. Everyone that joins us is like, there's problems in the industry, but not us. We're doing great. Everything is wonderful. But
we don't have any software exposure.
Yeah. Apollo said they're going to start to try to mark things daily, so maybe it's
true.
Apollo, ironically, or not, that leads us out of this. Lori, we're going to have to end things there.
Okay.
Thank you for joining us on your birthday. Happy birthday.
Thank
Are you going to get a cake?
My kids are demanding one. I wanted cupcakes, but they wanted a cake, so we're getting a cake.
I'm for a full cake.
They should be happy with either.
I'm still paying for the cake, so.
Lori, thank you so much. Wonderful to see you. That's RBC Head of U.S. Equity Strategy, Lori Calvasina. Let's get a check on your equity market. 10 minutes into your trading day this morning. We move higher by 1% after consecutive declines on the S&P 500 for 4 days. Last week, it was was the longest losing streak so far of this year. It's the Mag 7 leading us higher after entering into a correction. Nvidia up 2.2%. A Reuters report out just moments ago that they are forming a JV with private equity companies led by TPG worth about $10 billion. Meta also having a good day, the second best performer in terms of added points to the S&P after a report that they will be letting go about 20% of their staff. Micron, they're going to be reporting earnings on Wednesday, so moving ahead of that. To the downside, it's Walmart, Netflix, even though one battle after another, one best picture. Wait, that's not a Netflix picture, is it?
No,
so
not at all.
I guess that's the reason. Maybe it's down. I don't know. Anyway, Costco moves lower. Public Storage moves lower after a bid for National Storage, creating a $57 billion storage giant. Chevron is down because if you look at the individual sectors, everything is up except for energy, with the price of oil moving lower this morning, but not down really significantly. Infotech, again, that's the best performer, with Nvidia leading the gains, and they have. Oh, Matt, your memory is going to be better than mine this morning. The developers conference that they do.
The GPU.
Yes.
TC.
Yes, exactly that. But there is a good chart floating out there that apparently, when Jensen Huang tends to speak at these things, Nvidia actually falls. So it's not necessarily an indicator for how the stock will do. But again, there's that Reuters report of private equity money moving into OpenAI, more spending happening. So maybe Nvidia gets.
He sounds too much like a hype man, right? It's like, dude, you don't need to convince us. Just show us the numbers. But he's always trying to big him up. He's always like, oh, you can't believe how much demand there is. Okay, we can believe it. We see the numbers, but I think that's a problem.
Yeah. Sometimes it helps other companies like TSMC moves higher or something, or the memory chip stocks move higher because Jensen Huang talks about the memory cost, but Nvidia doesn't necessarily move. All
right, we're going to follow all of it for you. And of course, Bloomberg Tech kicks off at 11 a.m. We will be talking more about Facebook. Meta, the parent company, maybe the next big tech firm to lay off a ton of employees. Reuters saying a fifth of its workforce as it spends more on AI than people. Details next. This is Open Interest.
Let's get your top calls this morning. What the sell side is saying. First up, KBW. They upgrade Rocket companies, saying that the stock looks cheap based on its outlook for mortgage demand and Rocket's earnings. KBW believes that changes to the business could lead to stronger and more stable earnings. Shares up just under 7%. Next up, Argus is downgrading Adobe after the company's latest results and the CEO stepping down, saying that the leadership change overshadows its earnings and comes amid broader concerns about AI disruption. Shares down nearly 1%. Finally, Seaport Research, they downgrade Qualcomm to a sell, arguing a shortage of memory chips will hit Qualcomm's customers the hardest and leave the company losing share even as the overall market gets smaller this year. Little change to Qualcomm shares this morning, Matt.
All right, so some upgrades and downgrades there. Let's talk about a company that is rallying big on huge job losses, reports of huge job losses. Meta, according to Reuters, will cut 20% of its staff to offset costly investments in AI infrastructure. Today, Meta also announced plans to spend $27 billion over 5 years on that infrastructure with Nebius, a neo-cloud provider. Let's get a read on this with Bloomberg Intelligence head of global tech, Mandeep Singh. So, market's responding really positively, and obviously this has been a goal number one for Mark Zuckerberg, to turn the social media augmented reality AI company into an AI company. Is he going to get a real return on this kind of investment?
I mean, there are two ways to interpret this. One is that AI is driving efficiencies, and that's why, they're doing the layoffs. The other side of it is the foundational model has been trailing, the leading models like OpenAI, Anthropic, and Gemini. And they will be investing over $100 billion in CapEx this year. So they obviously want to carry on with that. And the margins are going to really look back. The free cash flow margins for this year are going to really look back despite the acceleration in top line that Meta is talking about. So from that standpoint, not having a product, a standalone app like OpenAI's or Anthropic is a problem for Meta, given how much they are investing. And so from that standpoint, to offset the margin impact, they're doing this ahead of time, because to me, the cut is really coming at the R&D line. Look at the R&D line.
But Mandeep, did they not need these people? Did they just have an extra 20% of staff just sitting around to be fired?
Well, what they are saying is all the product managers need to be more efficient in terms of how they are managing the team, and they are doing that proactively as opposed to the market forcing it when it happened in 2022, 2023. But other than the R&D line, they don't have as much cost intensities to cut. So if you're talking about a 20% layoff, it has to come, a bulk of it from the R&D line, because they spent almost $58 billion on R&D, in the last 12 months. So from that perspective, given their R&D intensity is much higher than a Microsoft or an Alphabet, it makes sense for them to, optimize that cost structure right now.
I mean, but again, the point you're making just seems like that can't be enough. Is that fair to say, that layoffs can't be enough to save your margins given the spending that they're doing?
Especially if the top line doesn't get that bump from, the large language models. I mean, look at how fast Anthropic and OpenAI are growing their revenues. Meta is growing a very healthy, 25% top line, but all that is coming from their core business. The apps that are very addictive, they continue to monetize them very well in terms of the feeds. But in terms of the pure play AI contribution from the large language models, whether it's APIs or standalone app, it's almost nothing. And you're really hoping that $110 billion of CapEx will translate into top line revenue. And that's where not having a cloud business, the infrastructure cloud portion that Microsoft and Google have, is a disadvantage for Meta.
For now, Meta shares getting rewarded up 2.5%. Mandeep, thanks for joining us on this Monday morning. That's Mandeep Singh of Bloomberg Intelligence. Coming up on Open Interest, BYD shares surge as the Chinese EV leader makes moves abroad. That's coming up next. You're watching Bloomberg TV.
BYD shares surging the most in 13 months, lifting with it other Chinese EV stocks such as NIO and Xiaomi. BYD's Brazil plant received orders for about 100,000 units, a sign of improving sales outlook in foreign countries. Bloomberg's Detroit bureau chief David Welch joins us now. And David, with all the success of these more affordable, smaller electric cars, with all of the talk about BYD maybe getting into F1 and World Endurance Championships, it seems that more people in other countries are ordering their cars.
That's right. And look, the Chinese car companies, especially BYD, have done really well exporting vehicles or setting up shop elsewhere. They've done pretty well in Europe, where they've gotten market share. South America is a big market for them now. They're growing there, and they're doing well in Mexico, right on our doorstep. And that's fed a lot of the concern among U.S. car companies and the other Western automakers that without some sort of protective measures, tariffs, bans, outright bans on their vehicles in the U.S. market, they'll take over here too, because China has far more capacity to build autos than it actually sells them domestically. So they're sending their vehicles overseas.
Is there any action, besides from the United States, to actually push on things like that, David?
There are. You're seeing more restrictions from the European Union, a lot of talk about it, higher tariffs. Canada, too, even though Canada is talking about allowing a small number of Chinese vehicles into that market, it's still a restricted market for them. And as part of the USMCA negotiations, how Mexico treats Chinese-made vehicles, that's also a big piece of this. What a lot of China hawks in the Trump administration and the domestic auto industry here wants to make sure that Mexico doesn't become, and for that matter Canada, sort of a backdoor entry point for Chinese vehicles into the U.S. market.
We are looking at gas today, David, that's up to more than $3.70. It's not an alarming national average like $4 or even $5, but the backlash against EVs, is that set to turn around as people realize they could actually save money with these things?
Yeah, I've thought for a long time, Matt, that there is an inflection point. It's not 370, but if we were to get gas prices to stay well above 4 for a while, you might have people, certainly they'll look at hybrids, right? And they already are.
but you could have them also looking at EVs if gasoline gets expensive over time. Problem with EV sales in the U.S. is once you take away the government incentives, there are too many trade-offs for a lot of consumers. But if they start to see benefit because fuel is expensive, then they would certainly give the plug-in vehicles and pure electrics another look.
My favorite hybrid is the Corvette E-Ray. It's just fantastic the way they put the power down. David Welch in our Detroit bureau, thanks very much for that. Tune in to my podcast because my co-host Hannah Elliott disagrees with me about the Corvette. It's called Hot Pursuit, and you can get it on your favorite podcast platform. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Burger. We get a bounce this morning after 4 consecutive days of losses. We're all oil traders now as the price of oil moves lower this morning.
Coming up, President Trump calls on other nations, including China, to help secure passage through the Strait of Hormuz.
And oil markets, though down this morning, may be set for more turmoil. Brent erases gains in a choppy session, still above $100 a barrel. The IEA chief speaks this hour.
And strategists across Wall Street say their investment case for U.S. stocks remains intact despite risks posed by the war with Iran. RBC's Lori Calvasina weighed in the last hour.
We have said that the second tier of fear, which is what we had last year, that 18.9% drawdown, we've had 5 of those since the great financial crisis, where we've had peak to trough declines of 14 to 20%. Risks of that have grown, but you have to get to a point, right, where there's genuine fear of either a recession or some sort of contagion. And I don't think that's where we are yet.
Joining us now is Ann Berry, Threadneedle Ventures founder. Ann, thanks so much for joining this morning. I think it's fair to say that, there isn't a lot of fear. Yes, stocks have been down, but not massively. At what point does a war stretch on? Does oil stay elevated enough that you could see something that rivals a real correction in risk assets?
I think you just named it. I think it's the war stretches on and oil stays high. And there's a second piece of noise that's starting to come up, which is the administration is starting to ask questions around who stands with them in this war in the Middle East. And if the answer is not as many as they would like, it does raise a question around, is there another round of tariff adjustments that we are going to see? Because we have seen foreign policy and tariffs closely correlated in the past. And I'm not sure the market can stomach another round.
Have we seen, though, enough of a correction in some assets? I know on Friday I heard, I think, Romaine say that the Mag 7 index, Bloomberg has, compiled its own index, is in correction territory. Is it time to buy some of these stocks, some of these babies that may have been thrown out with the bathwater?
So I don't think so when it comes to the Mag 7, Matt, because I think those who've seen valuations run over quite a sustained period of time, we've talked about it on the show. But I do think where we've seen babies being thrown out with the bathwater is a little bit in the software sell-off, and I've been spending some time trying to wade through, trying to rescue the infants, right, from the puddles of water. And I think there are a couple out there. I do think cybersecurity stocks remain oversold. I'm watching CrowdStrike dip down again this morning. That, to me, is an opportunity. And then there's a couple where I've really tried to dig in and listen hard to find the CEOs who are able to articulate why they think their moat will sustain itself. And Zito Global is one of them. Now, marketing is a tricky one. Marketing technology is a tricky one. This is a business that can point to a proprietary database. It's absolutely enormous, more than 500 million data points. And it has the ability, provably, to deliver 600% plus ROI to its customers, which means it's got pricing power over time. That's the kind of thing I say, you know what, maybe this is an opportunity.
And software in past moments when there's been disruption in supply chain risk has been so attractive because it doesn't possess that. I wonder how you're thinking about supply chain risk. There was a really great story from our Bloomberg News team about helium being one of the important things that gets routed through the Strait of Hormuz. And apparently that's an element that's been used in the semiconductor industry. So semiconductors might also be at risk from the Strait of Hormuz being closed. Are you concerned at all about wider ramifications, not just higher prices of oil, but chemicals, other things that are needed for many global industries to survive? Fertilizer?
Absolutely, and I'll throw in the other one there. Let's talk about memory. Right, let's talk about data centers. We've seen what's happened with the South Korean index. Fell off a cliff the second the Strait of Hormuz started to close because the vast majority of memory manufacturing is happening in South Korea. It's the equivalent of chips in Taiwan. Right, and if South Korea does not get its hands on much needed oil and gas, it cannot power its manufacturing plants, it cannot get memory out here. So absolutely worried about supply chain. And back to your point, it's if this war is prolonged, if the Strait of Hormuz remains closed for a long time, if we see oil prices go up, or we see choke points to key industries like the ones you've just listed, that to me is not only sustained correction territory, it's going to force the level of discipline to come back that we haven't seen in 3 years.
We love talking about individual companies with you because you dive deep into the research and pick out anomalies. I guess Campbell's Soup, or now it's just the Campbell's Company, because they obviously make Pepperidge Farm and like Kettle One potato chips and
delicious
all this stuff.
Yeah.
Hanover's, Snyder's, I don't know which pretzel, but they make snacks other than soup, and they're not doing a great job at selling them.
Not a great job at selling them. Look, we saw the earnings. You covered it. 20-ish year lows now when it comes to a share price. And here's why I've got my eye on it. Not because I'm a believer, right, that it's got some magic that's about to be unveiled, but for the following reason. I've talked on the show with you both before about how activists are having their moment in the sun, and following that money is fascinating. If you take a look at what's happened in food, you've got activists all over Pepsi, right? Snacks have been struggling there, so Elliott's got a $4 billion stake. Stuff is now happening. You've seen Kellogg's, it held its nose, it split itself into two. Now one part owned by Mars, one part by Ferrero. General Mills has got a turnaround plan. It's digging deep into pet. Campbell's hasn't said anything. So this, to me, I've bought because, to me, it's right for an activist to go in and start shaking things up and to have a catalyst for some upside.
By the way, you could have gone on and on and on there with activists and food stocks. I hadn't thought about it. I mean, you've got Heinz, you've got Wendy's, you know. There's just so many activists in foodstuffs. What's up with that?
There's going to be a lot of movement. Like Kraft's another one, right? That was going to separate itself. CEO said, hang on, no, take a beat, give me a shot. I think I can fix this. We need to hear something along those lines from Campbell, or we're going to see it's going to get broken up. If it doesn't break itself up, we'll do something dramatic.
I love this conversation. By the way, just after you, I can see waiting in the sidelines is Liekefett from Sidley, who co-chairs Activism at Sidley.
Oh, there we go.
Perfect timing.
Yeah, perfect timing.
I'm going to ask him this too, but I'm curious for you too, because a lot of activist outcomes are M&A. You sell the company. But M&A markets have been challenged because of the greater volatility we've seen. What happens if that avenue is closed for activism?
I don't think M&A has been shut down. And actually, it was kind of active towards the end of last year. And there was hope that there'd be a lot of M&A activity this year. I think that good assets will always find a home. Good assets will always trade. And the other piece of this, I would say, is there are lots of different food assets in particular. If you think about the buyer base, you've got other strategics. You've also got a lot of private equity money that's historically gone after exactly these kinds of assets, partly to try and strip out more costs more aggressively, partly to try and find ways to then bolt on higher growth kinds of assets to get them moving again. So I actually think that there is a way that M&A could still exist in this particular sector.
And great to have you on the program. Thanks so much for joining us. Ann Barry there of Threadneedle Ventures. To get a check on the markets right now, we're looking at some big gains. You can see the small caps up 1 2/3% with the Russell there. S&P 500 up 1 1/4%. NASDAQ gaining 1 1/3. So as oil comes down and you see Brent crude at only $100 a barrel right now, you can see investors are getting into buying more risk. Here's the Brent chart right now, down 2.6%. It's fascinating. Do investors think that China will come to President Trump's aid?
I mean, the mood music from China suggests that they won't be. But I mean, it's a trend that we have seen. The prices spike overnight in the Asian session.
That's a good point, yeah.
And then they start to come down the U.S. session, and then they're a little bit volatile from there. So a couple hours of trading maybe does not a trend to me.
Yeah, I turned on last night, and we were at $101 a barrel for NYMEX crude. Coming up, we're going to speak with Kai Liekefett, as Dani just pointed out. He's co-chair of Shareholder Activism practice at Sidley Austin, with proxy season underway in the U.S.
Plus, the House returns to Washington today with affordability concerns top of mind. We're going to discuss with Missouri Representative Jason Smith, only here on Bloomberg Open Interest. Investors are navigating geopolitical uncertainty as the war in Iran continues, including shareholder activist Kai Liekefett, co-chair of Shareholder Activism practice at Sidley, writes, quote, the Iran war may function as a short-term poison pill for proxy contests, not because it strengthens corporate defenses, but because it increases the risk associated with activist commitments. And Kai joins us now. Kai, thanks for joining. First of all, this is long overdue. Thank you for joining us this morning. What specifically is it threatening? Because you could argue, I mean, activism, it's about the company fundamentals. It shouldn't be impacted by this this overall macro layer. So where do you see the stresses coming in?
So the issue for activists is seasonality. Proxy season is underway, and this is the time of the year for activists to put up and shop up. So what do I mean by that? Activists identify companies that are undervalued and then are trying to push them to make changes to unlock shareholder value. However, the way to do that is by putting pressure on the board, and the board is up for election once a year at the annual shareholder meeting. The annual shareholder meeting, in turn, at most public companies, takes place sometime between April and June, and the nomination deadlines under the bylaws are typically around March. So this is a time of the year when activists actually have to decide, okay, do I commit to a proxy fight to oust a board or not?
So do geopolitical events like the war in Iran typically have a bad effect on proxy battles? I mean, do they typically affect these activist campaigns? When you look back at, I don't know, Gaza or Ukraine, did you have the same effect?
We had similar issues at the onset of the COVID-19 pandemic in 2020, and last year during the trade war after Liberation Day. A lot of activists decided to pull back. And they decided to pull back because it's pretty hard to launch a full-blown proxy fight and then say 2 weeks later, never mind, I'm out of here. Because activist hedge funds are repeat players. They're dependent on other investors supporting them. And no ARB, no hedge fund is going to support an activist the next time they go into battle if they are not sure that they're not chickening out.
Wouldn't this be the best time, though, especially if you have a lot of stocks coming out that have been sold off over war risks, for an activist to come in and see some pretty handsome returns if they can lift up a company from the sell-off they've seen?
There is something to that. So what we saw both during COVID-19 and last year after Liberation Day was that a lot of activists were buying in on the dip, acquiring new positions during this market turmoil, and then approach target companies later in the year, in the summer or in the fall. But it's too late to do that with new targets, this proxy seasons, because typically the deadlines for nominating an alternative slate of directors have already run.
Although if you believe strongly in a case for an activist campaign, if you think a company is being operated inefficiently, that's going to stay the same through the year. So does this build up? Like if the war delays proxy battles this season, aren't there twice as many next season?
It's a great point. So as you probably recall, JFK once said, the rising tide lifts all boats. Well, the opposite is also true, right? I mean, a sinking tide really destroys a lot of boats. And when you think about it, a lot of companies that are not well managed can fly under the radar during good times. And during a crisis like this, it becomes more and more apparent who is actually not well managed and who is not.
So the other impact of general geopolitical strife and macro uncertainty is more volatile markets. I was speaking with Paul Taubman on Bloomberg Deals next week, which I know I'm going to force you to join at some point as well. But basically saying this idea that between the volatility from AI, from geopolitics, that deal activity is maybe going to be more muted than we thought in 2026. What does it mean if M&A markets aren't as open for activists?
Well, that forecloses path number one for activists to make money, because activists, at least in the small and mid-cap range, they really try to push companies into a sale. That's the easiest and quickest way to make a buck for an activist. But they have alternatives, right? Pfizer CEO, capital allocation, cost cutting. So it doesn't foreclose activism. And also, it's an interesting dynamic with M&A. Yes, all of what Paul said is absolutely true. Paul is typically right about pretty much everything. But there's one major factor which is a counterbalance to all of this, which is this administration is perceived by many as the most lenient in terms of antitrust and regulatory oversight in a generation. So a lot of boardrooms and a lot of C-suites, what we hear is, look, you want to do a transformational deal? It's now or never. Notwithstanding the otherwise choppy market.
Do you think that's still true for companies where affordability is an issue? What if you're looking at something with a consumer company and this White House is obsessed with keeping prices down? Could they not be more forceful in antitrust action?
Well, politics is always dangerous to comment, in particular on live TV, if you want to keep your job. But look, it all depends on the optics. If a household name is involved that is closely associated with rising prices, you might indeed face an issue in Washington. Other than that, I'm not so sure it's going to make a huge difference.
Have we seen, though, the reduction in regulation that the market really was hoping for? I mean, I remember at the beginning of President Trump's term, hearing people say, like, the most important thing he'll do is not add new regulations. And this is what we thought would lead to also, at least in part, an M&A boom. Have we seen that?
Well, thankfully, not so much, because I'm a lawyer, and I mean, yes, the less regulation, the less for me to do. So it's a nightmare scenario for my profession. But look, kidding aside, yes, I mean, the Trump administration has made an effort to cut regulations, including at the SEC, which is doing a great job, actually, weeding out some of the unnecessary regulations. So I'm not sure it's a major driver of growth just yet, but I mean, it's clearly in the right direction.
The other existential angst that everybody is grappling with is AI. And we've seen on the CEO level, the executive level, some turnover there too. Adobe, for example, last week releasing their CEO, maybe that's a too kind way to say it, firing their CEO over concerns that AI is going to have on Adobe. Does activism play a role here of coming in and trying to counsel or find the right executive? How much of that do you think is going to fuel some activist campaigns?
I think activists know exactly as much about AI than anybody else.
So not a lot?
Not a lot. I think we are all grappling with what it actually means for corporate America and the world. But I think what we're going to see in future years is we're going to see companies who are going to miss a boat on this, and this will be apparent even to activists. And there are other companies who are going to embrace AI as a mechanism to create value. And there's going to be a clear tale of two cities down the road, and activists are going to clearly come after those companies who didn't get the memo on AI.
Kai, great having you in the studio. Hope you can come back and join us again. Kai Liekefett there of Sidley talking to us about activism amidst geopolitical upheaval. Now, the House, speaking of that, returning to Washington today after a week-long recess with affordability concerns front and center as the war in Iran keeps oil prices and, more importantly, prices at the pump higher. Joining us now is Missouri Representative Jason Smith, who also serves as the chairman of the House Ways and Means Committee. Representative, thank you so much for joining us. Appreciate that your time is incredibly valuable, especially now. I wonder how important it is to you and to Congress that we get a formal justification for this war that's driving up prices and formal objectives clearly laid out from the administration.
You know, I think the president has been very clear that this is going to be a short-term excursion, and that the bump in the increase in oil prices is just the result of a temporary problem. The good thing about it is no one's talking about Trump brought down the cost of gasoline for the lowest levels in 5 years until what was happening in Iran. You know, it's a little bit unstable
until he decided
right now,
to attack Iran. Maybe Israel let us in there, but I thought it was interesting that the Israelis are looking to add $13 billion to their defense budget. They're not sure if they can because they already have a 3% budget deficit, and they're already running 69% debt to GDP. Meanwhile, we're running like a 6 to 7% budget deficit and 100+% of debt to GDP. We need to add tens of billions, maybe hundreds of billions of dollars to our defense spending. Does it make sense that we're doing this for Israel?
We're not doing it for Israel. We're doing it because this is a country that has repeatedly said death to America. Not death to Israel, death to America. Without a doubt, you have every world leader in the United States that has said the Iranian form of dictatorship was a threat to America.
Chair, I think just a lot of, if I can jump in
Joe
here,
Biden,
just because a lot of Americans looked at, this new incoming administration when they were incoming and saying, this is the party I'm voting for because it represents peace and not war. Instead, we do have gasoline prices now above $3.70. They're at the highest level since October. I just want to be clear, is your message to the American people the same as President Trump's, that higher oil prices is just a small price to pay?
It is a temporary price to pay, but what I would point out is the price of gasoline right now is still lower than what it was when Joe Biden was president just a few years ago.
It is, for sure. We saw prices get to $5 a gallon, I think, around thereabouts during the Biden administration. It is increasingly difficult, though, to see an off-ramp here, Representative, because President Trump has said he will accept nothing less than an unconditional surrender, and he's called for regime change. And it seems like what we have after killing the Ayatollah that was a problem for many administrations is a new Ayatollah. I mean, there hasn't been any change in the dictatorship or the IRGC-led government in Iran. Does that have to change before we can get out? Unless you know something I don't know, we don't even know if they have a leader right now. And so that is, sounds like a regime change, and it works right there. Because it's really the IRGC representative that holds the power in Iran. Do we need to see that organization destroyed?
It'd be great to see if they even exist. Put them on camera. That's something that they're not doing right now. What we need to do is have that regime completely dismissed and allow the Iranian people to actually thrive and to form their own form of government, not a government that kills thousands of innocent Iranians.
Representative, the Pentagon has told officials that in the first 6 days of this war, it cost America $11.3 billion. This was supposed to be the time and the party to rend in spending. How can you do that as long as this war continues?
What I will say is, in the first year of President Trump, we actually reduced the deficit from the prior year under Joe Biden. So there's always more work that we can do. We can always continue to cut spending. But what has been great is that the president's economic agenda has led to record revenues for our country, which is helping lower the budget deficit.
Well, the president has suggested we should be spending $1.5 trillion on the military budget for 2027. That's a 50% increase. Are you for that as well?
That's going to be very difficult to do. We're going to have to look at all different ways to maximize the right budget that's best for the American people. But that kind of increase would be very, very difficult to do.
Chair, there's been a lot of speculation in energy markets right now that the Treasury or maybe another government entity has been taking positions in oil futures, shorting them, or trying to manipulate the price lower. The Treasury Secretary on CNBC this morning said that they're not present. Are you aware of any federal entity participating in oil market futures?
Not at all.
Would it be appropriate for them to do so? Would you counsel that they do not do so, given that it could expose taxpayers and the American public to large positions in this energy market?
I would say it would take smarter people to make those decisions. That's an area that I'm not focused in, but we need to make sure that the United States is always at a competitive advantage in every front.
How long, you've said maybe this is a short excursion, how much longer will Congress allow this to go on before you start to demand a set of clearly defined objectives from this administration?
I believe that the president has a clearly defined objectives. I also believe that this is not going to it's not going to go on much longer. President Trump, speaking to him when he spoke to the House Republicans just a week ago today, was very clear. This is a very short-term excursion.
Representative Smith, what is your understanding of what short-term is? I think that's a large question still dangling out here. Is it a week longer? Is it weeks? Is it months? What is short-term?
I don't have a crystal ball. But a short term is a short term. You know the definition in Webster's dictionary.
I guess this is the problem.
I would encourage you to read that.
Without
Don't
a clear
continue
outcome,
to try to pin me to say something that
is?
I'm not going to answer.
Okay, but I guess if we don't have a clear outcome, we don't know what that looks like. How do we know that it's short term when you have Iranians who clearly are not backing down?
Well, the Iranian people are in support of what we're doing. It's the dictatorship form of government that is not supportive, which is barely hanging on by a thread right now.
Does it concern you that President Putin seems to be a clear beneficiary here? We've got our eye off the ball in terms of what's going on in Ukraine, and he is allowed to sell his oil for more.
These questions are absolutely ridiculous, to be completely honest. What concerns me is that you all are okay with the former Iranian form of government that killed thousands of their people. Because by your questioning, it shows that you supported the prior government and the prior leader that killed thousands, which I believe is
Representative,
unacceptable.
thank you.
While taking the necessary action to defend ourselves and our allies, we will not be drawn into the wider war.
That was UK Prime Minister Keir Starmer speaking after President Trump called on allies to help reopen the Strait of Hormuz. Officials in the European Union and Japan also expressing unease about getting pulled into the war in Iran. Joining us now is Wayne Sanders, Bloomberg Intelligence Senior Defense Research Analyst. He is also a retired Army colonel. Colonel, what's your take on the president asking others, including China, to help the U.S. Navy reopen the Strait of Hormuz?
I think one of the biggest pieces here is the fact that the president's trying to treat the Strait of Hormuz as being a truly economical piece that is, in everybody's benefit at this point in time to be able to reopen, and trying to keep it separate from military action. But obviously, the asymmetric way that Iran actually attacks the vessels through the straits, as well as infrastructure across some of the Middle Eastern partners, you see some of the reticence right now that's coming into play.
What about not just China, but more broadly, the ability of NATO to escort ships through the Strait of Hormuz?
Well, I think that's one of the biggest things that becomes, it's a very asymmetric problem like we had in Iraq back in the early 2000s as well. Is all it takes is somebody with a shoulder-fired missile, something that could easily be smuggled. So even if you take out all the rest of the military capacity, you still have an asymmetric threat that can cause a problem on the geopolitical stage. So even if the U.S. is doing a great job, they are decimating the military, they're doing it against conventional military forces, right? They're not dealing right now with a lot of insurgent-type capabilities that we used to see in the early 2000s, but it's something that can be there. All of those port cities that are all around the Straits of Hormuz, that could be somebody who has eyes on and is, calling in for fire, if you will, against that specific target, and it's something that has to be dealt with. So those military escorts becomes a key piece of this, whether it's patrol craft or it's blue water escort forces. The U.S. can do it, but the U.S., I think, is looking for the rest of the world to say, hey, we've taken care of the military threat. Now let's figure out steady state operations.
We just spoke with Representative Smith, who said there's doubts that Iran has a supreme leader and that the IRGC exists in its former state. How do you think Iran is doing in terms of people that are actually left to run the country?
Whenever somebody puts together a high-value individuals list, right, an HVI target list, and put those pieces into play, you always have to worry about what that power vacuum ends up looking like. So even if you've gone through and you've hit the first, second, and third tier of individuals, there are people who are going to try and vie for power. But if everybody who's coming in ends up getting killed, you're now going to end up with somebody that's below that, that's probably going to have to come towards at least a little bit a malleable place from geopolitical diplomacy to be able to come back to the United States and say, hey, okay, I see what you're doing. I think the Trump administration and the U.S. military has done a good job to say, hey, look, we're not going to allow this regime to stay. But without putting boots on the ground, obviously, there's a limited amount of capacity you can do that.
How big of a risk do you think, Wayne, is that that's where we end up? That in order to get the regime shift that this president and this White House wants, that's a necessary step?
It's probably, when intelligence professionals put together, they look at what's considered the most likely course of action and then the most dangerous course of action. And obviously, allowing remnants of that regime, the old regime, to stay in power during this time frame is probably one of the most dangerous courses of action in there. What they are trying to do, though, is systematically dismantle everything that they have from a production capability, so that even if you try to keep those people in power, they don't have the resources, production capability, scalability for these weapon systems to do it. If you look at they originally said that Iran had the capability to do 10,000 Shahed drones a month in production value. So even if we took out 80%, that still leaves 2,000 a month that they could potentially put out there. So it ends up being something to say, how can how validated are we? How confident are we? There you go. How confident are we that we've actually hit enough of that production capacity? And will we continue with limited strikes on that if they keep trying to build it back up?
Colonel, I want to ask, as a former soldier, what was your take after the Secretary of Defense on Friday said, we will give the enemy no quarter, no mercy? Surely he knows exactly what that means. And it has been considered a war crime since the Civil War here and internationally since The Hague.
I think the biggest piece that he's really trying to focus on is increased pressure. The words that he used, probably not the best that he could have used for that. But in terms of keeping the pressure on the Iran regime, everybody, I think, right now is assessing that if you allowed them to be able to regather and regroup, they would be able to find a leader or somebody that could try and push forward this charge. But what they've done over the past few weeks is be able to say anybody that's in these positions, they are not going to survive, or they're going to be continually targeted so that they can continue to put that pressure and allow the Iranian people the opportunity to raise up against that regime and put themselves in power. Now, how well they're doing that, with Ali Larjani and others, as you've seen, 30,000 plus killed even during the protests earlier on. These are those types of military calculus and decision calculus that Secretary Hegseth has to put into play.
Colonel Wayne Sanders, thank you so much for joining. Really great to get your insights. Wayne Sanders of Bloomberg Intelligence with a storied career in both the Army and the Department, the Undersecretary of Defense. Joining us now is Tina Fordham, founder and geopolitical strategist of Fordham Global Foresight. Tina, wonderful to see you. Matt and I were just speaking with Representative Jason Smith of Missouri, who repeated President Trump's word that this will be a short-term excursion. What is your understanding in whether there is an off-ramp that allows this war to be short-term?
That was a spectacular interview, so congratulations to both of you on that. But my approach to looking at this conflict and indeed all of the geopolitical risks that are proliferating out there is a political science perspective. And so we were very early in saying that the likelihood that this would be a short war is basically fat chance. It's not going to be a short war, and any military strategist will also tell you that the enemy has a vote, and that's exactly what we're seeing right now. Another aspect, which I think has been treated oddly by your last couple of guests, is the notion of regime change either imposed externally or happening as a grassroots phenomenon, neither of which is transpiring at this stage, and that just adds to the low likelihood that it's a short war.
Tina, I wonder what you think about the benefits Vladimir Putin gets from this war. I can't help but think we've taken our eye off the ball in terms of defending Ukraine. We've driven up the price of Putin's oil, and now we're taking off the sanctions that held him back from selling some of that oil. It seems to me he could be giving a portion of those proceeds back to Iran to keep this war going because that's in his interests.
Indeed, the unintended consequences, the second and third order effects, I mean, I talk about these as the geopolitics butterfly effects, are manifold. And one of them is that the combination of the oil price spike plus the fact that the U.S. Treasury has rolled back selectively some sanctions on Russia is a big boost to the Russian Treasury and for its war efforts. And so Russia is benefiting in a big way. And of course, Iran is also a long-standing military ally and cooperated with Russia on nuclear for some time. China and Russia are both supporting Iran, which the U.S. is at war with. And President Trump has asked China to send ships to police the straits. And so we're really looking at the most unbelievable set of geopolitical bedfellows here. It is quite perplexing.
And in that, the president has suggested that he would delay his summit with President Xi to try to convince them to help escort ships through the Strait of Hormuz. Tina, what does this conflict do to American and Chinese relationships?
Well, the idea that would be, that the threat of postponing the U.S. state visit to China, which is always a great honor for any visiting foreign dignitary, would somehow, persuade Xi Jinping to do something that he didn't want to do, I think is not likely to produce the result that President Trump hopes for. Remember that it was only a few months ago that China was able to marshal its superiority in critical minerals to force a U.S. climb down. And so we're in a situation right now where the White House is issuing threats to both traditional allies, NATO allies, Japan, for example, South Korea, as well as China, to say that it needs to police the Strait of Hormuz because, the pretext being the shared global economic interest, energy market interest. But I think if you look at the words, for example, of the German defense minister, this is not a war that we started. Nobody asked us about undertaking this objective. It's pretty easy to see that no one is going to want to respond to the president's call, so that if I'm an investor right now, I'm going to be asking what President Trump will do next to make good on these threats.
Tina, clearly very few people were fans of the Ayatollah and probably won't be fans of his son if he's leading as well. But is it fair to say that the administration hasn't done well to formally lay out a justification for this war and hasn't given us clear objectives?
So if you're going to try to game out how a conflict ends, you need to understand what the objectives are. And we don't know what the objectives are in this conflict. We've heard different things at different points from the White House. The regime is unpopular. The estimates from Iran experts are that it maintains around 20% of popular support, which is not nothing. But what's more important is that this is a regime that has structures and institutions, and that's what's keeping it, resilient, if not intact. Not only that, it also has a very sophisticated security apparatus. That's what came out when the mass protests, we've had several waves of mass protests in Iran have taken place. And we've got a traumatized, beleaguered population here that isn't armed. And so their ability and willingness to come out and overturn this regime is minimal at this stage. It's unpopular domestically. Iran's regime is unpopular in the region, not just with Israel, but with the Gulf states as well. But that is not the same thing as suggesting that it is fragile and about to break up. And that's where the real risk is, that Iran is a weak or failed state, 92 million people in control of a major choke point in the global economy.
Tina, you are one of the best. Thank you so much for joining us today. That is Tina Fordham, founder and geopolitical strategist of Fordham Global Foresight. Let's get a check on your markets this morning, because as the price of oil moves lower, we are rallying. We're still, though, above $100 a barrel for Brent crude at 101 to be specific. But bond yields come in a fair amount. We're down nearly 5 basis points for your 10-year yields. We're finally pricing in one full rate cut for this year from the Fed. We're going to have the Fed, ECB, BOE, and BOJ with decisions out this week as your equity market moves higher by about 1%.
Coming up, as Middle East tensions add new uncertainty for global markets, we'll talk to Peter Burke, Ireland's Minister for Enterprise, Tourism and Employment, about the future of Ireland's economic ties with the U.S. This is Bloomberg Open Interest.
We are prepared in Ireland to act, but we're trying to make sure that the course of action we take is the correct one. Because while we're talking about energy today, should this conflict go on for a prolonged period of time, of course the economic impact is beyond energy. Inflationary impact on growth, impact on the Eurozone. So we do need to try and make sure we get the best possible data across the Eurozone in the days ahead.
That was Ireland's Finance Minister and Deputy Prime Minister Simon Harris speaking to Bloomberg about the economic impact of the war in the Middle East. Meanwhile, Ireland sits at the center of U.S. tech, pharma, and investment flows into Europe. So how are geopolitical tensions, tariffs, and AI investment shaping that relationship? Joining us now is Peter Burke, Ireland's Minister for Enterprise, Tourism, and Employment. Thanks so much for your your time this morning, for joining us. It's an incredibly valuable partnership that the U.S. has with Ireland. How do you look at it? What's the most valuable part? It must be U.S. companies investing in Ireland.
I think, first of all, the most valuable part is our people. We have so much of a connection. We have 32 million people who have Irish heritage in the US, and that is getting stronger in terms of growing the relationship. But in business, we're now the 5th lead FDI investor in the US economy. And which is very striking, this week we're announcing over €6 billion of further investment with a number of our companies from Enterprise Ireland, growing our footprint here. We have about 200,000 people employed right across the 50 states, and that's one of the key things in some very rural areas. And as a government, we're very much committed to growing the bilateral relationship to get benefit on both sides.
So on the other side of tech companies coming in, I wonder what you then make of headlines like we've seen this morning of Meta laying off 20% of their employees, saying it's because of AI. A lot of these tech giants are moving towards that world, saying we need less employees because of our use of this technology, just given how present they are in the Irish economy. Does that concern you?
What we're trying to do is to lean into the opportunity that AI presents. So in relation to where you have vulnerable workers, what we've done is we're really training, transformational training of a number of vulnerable cohorts to try and ensure that they can lean into the benefits of AI in the future. And one of the striking things, our key agency, the IDA, which is responsible for foreign direct investment getting into our country, so bringing American, US companies, which employ about 245,000 people, into Ireland, we set a target over 4 years that we'd train and upskill 40,000 people over the 4 years. In year one, we've hit 33,000. And that really shows you that transformational change, that you want to embed that opportunity at the heart of the economy and give people the chance to get the high value aspect of artificial intelligence, which is very important as well.
It is surprising to hear that Ireland is the 5th biggest FDI investor in the U.S. I mean, that's absolutely massive, only behind countries like Germany and Japan, right? How did that happen? Because Ireland is a relatively small country.
I think the connection is key, but the US obviously is a key market for companies to scale. And for us, getting new companies to come out, it's incredible to get into the US market, which is very important. But also, I think the connection, we've built up a very strong ecosystem in Ireland. You mentioned semiconductors, the life science sector, very much cohorts that have academia working in partnership with industry, commercializing that research, and the tax system is very much supportive of research, development and innovation, and trying to keep Ireland on the forefront of the innovation curve. And that's what the government is about, keeping those high value jobs, trying to embed that ecosystem that we have, that rich vein of talent. And when you look at Ireland and you look as a segment of our population, 1 out of every 5 people that are working in Ireland now were not born in our country. You can go into some companies in the landscape in Dublin, there's 80, 90 different nationalities ever present in them. And that just shows you the talent pool that we have and that we want to grow and cement into the future.
The world does seem to be moving in a more insular way, and it is a president of the United States that's pushed Europe to be more self-reliant. Has that changed at all the incoming flow of both direct investment in talent over the past 2 years?
No, we actually had a record year in our IDA investment come into Ireland last year, 323 new investments. A quarter of them were new name investments, new companies coming in, which is very significant. But one thing I've experienced over the last number of months, despite the noise on the geopolitical landscape and the uncertainty, we only have to turn on our tellies, our phones and see the huge uncertainty there is. The operating reality on the ground is trade continues to flow. If you look at between the US and the EU, every single day over €4 billion of goods and services flows over and back seamlessly across the Atlantic. And that's what we want to continue that certainty and ensure that citizens on both jurisdictions benefit for that. Because ultimately, that's why we're in politics, that's why we all do what we do, is to give citizens that benefit, that opportunity in life.
And Ireland's Prime Minister, the Taoiseach, expected to meet with President Trump this week. What do you hope to get out of that meeting?
I hope it continues to grow our relationship, that closeness, as we approach America 250. And if you look at the Declaration of Independence, incredible to say that 3 of the signatories, 3 of the 56, were born on the island of Ireland. You have so many people from politics, from building up these great cities across the US, the infrastructure. So many Irish people were core, front and central of that. And the message we'll be bringing to the President and our Prime Minister and Taoiseach, Micheál Martin, was we want to continue investing in your economy. We have over $6 billion now over the next 4 years from Irish companies. They're going to be scaling, growing further. Places like Curry Group that invest €1.5 billion in raw materials every single year across the US in very rural parts. We have Smurfit Westrock doing huge investment as well, and Glanbia, CRH, Ryanair, a huge order in with Boeing for over 300 MAX aircraft. That's what Ireland is about, investing in a two-way beneficial relationship.
Minister, we really appreciate your time. Thank you for stopping by.
Thank you. It's great to be here.
Great to have you. Enjoy the rest of your New York City tour. That's Peter Burke, Ireland.
And happy St. Patrick's Day tomorrow.
Happy St. Patrick's Day.
A very important thing to say. Ireland Minister for Enterprise, Tourism and Employment. Coming up on the show, we're going to set you up for a week ahead. It's an extremely busy one, a Fed among other central bank decisions. This is Bloomberg Open Interest. Let's get you set up for your trading week this week, 2 p.m. New York time. Nvidia CEO Jensen Huang is speaking at his company's GTC conference. Then tomorrow, retail earnings will continue. We'll get results from Lululemon as they face activist pressure from their ex-CEO Chip Wilson. Wednesday, Macy's and Micron report earnings. Plus, we're going to get a Fed rate decision from Chair Powell and the news conference. Thursday, another round of jobless claims and results from FedEx and an ECB decision. And then finally, on Friday, Carnival reports earnings. By the way, within there, we also have a BOE and BOJ decision. So a big week for central banks. Whether or not they actually do anything, that's another question.
Yeah, so there's a lot going on. Suffice it to say, however, that traders are very much focused on the price of oil. So it's likely that we continue to see this relationship. When oil prices go down, markets go up and vice versa.
Yeah, I mean, that's what we're seeing this morning. If you look at markets, the price of oil, it still is around $100 a barrel. Just barely at 102. It is down, and that's what's allowing not just equities to move higher, but also rates to come in too. 10-year yields are moving by quite a lot, down by about 5 basis points. So we finally back again have 26 basis points of rate cuts priced in if you look at WIRP on the Bloomberg terminal after dropping below that level.
All right, coming up tomorrow, Martin Norton of Empower joins us, as well as Park Square founder Robin Dumar. Blackwater founder Eric Prince will be on the show, and Merlin Labs CEO Matt George. This has been Bloomberg Open Interest.